Hello, everyone, and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video, we are solving the questions from chapter number 19 quiz that is there on your study hub. With the questions getting different from what you find in the study kits in your exam. So, because of this difference, it becomes highly important that you practice section A and B questions now from the other resources like Study Hub as well. So here we are. Let's get started. Now, the first question asks you which of the following statements about a company with high operating gearing is true? So, basically, operating gearing means that the proportion of the fixed costs that a company has is very high compared to the variable costs. So, let's read statement by statement and let's eliminate, the answers which could not be the answer. All right. A change in sales will have a relatively small impact on profits. Now, over here, if you have a high operating gearing, this means the proportion of your fixed costs is high. So, if there's a change in sales, that means if the sales are getting reduced, because the proportion of your fixed costs are high, it's definitely going to have a big impact on your profits. So, that is why option A cannot be your answer. Moving to statement B, the company has a relatively high proportion of debt finance. So, debt finance primarily is about the financial gearing and not operational gearing. A company is said to be financially geared if it has the presence of debt in its capital structure. So, option B also gets eliminated. Now, let's see option C. The company will have higher risk and increased potential return. Now, this seems something true that, because your fixed costs are high, you have higher risk because you need, in order to maintain those fixed costs, to be able to pay for those fixed costs, you need to have, the sales and everything. But once the fixed cost has been met, any increase in sales that you get is an increased return. So, definitely you have a higher risk, but also with an increased potential return. Once you have covered those fixed costs, any extra sales that you make straight away goes to your profits. Then let's talk about option D. The company has a relatively high proportion of variable costs. Now, this statement would have been your answer if, except from variable, it had written fixed costs. But since it is talking about variable costs, this is not what operating gearing talks about. That's why option D also gets eliminated. So, conceptually, as well as through the method of elimination, you will arrive at option C as your answer. Moving ahead to question number 2 now. So, Harbor Company has had sales of this much and an asset turnover ratio of this much. Their return on investment is also given to you. We have to find out the capital employed as well as the operating profit. So over here, we're going to need something to solve. So that's why I have opened space for me to work out the calculations and show them to you. So let's get started. Number one, I see that the sales figure are given and the asset turnover is given. So we know the formula of asset turnover. Asset turnover. The formula for the same is sales divided by the capital employed. So the sales are already given and they are given as 1.5 million. And you also have the turnover ratio, capital employed. So with this, you can find out the capital employed. 2 is given to be the asset turnover ratio. So capital employed will be nothing but 1.5 million divided by 2. So this gives you 750,000 as your capital employed. Now that you know your capital employed, it's either going to be option B or option C. Now let's see what our operating profit is going to be about. So return on investment is given to us. And we know the formula of ROI as well. ROI is nothing but operating profit divided by your capital employed. So now we have ROI also given to us as 6% is equals to operating profit we need to find out, and this has to be divided by your capital employed. So capital employed we just worked out above as 750,000. So 6% of 750,000 is going to give you your operating profit, and if you work out this calculation you will get it as 45,000. So doing all of the numbers, you get your answer as option B over here. So you select that and you move ahead. Now this is again a numerical question that we have next. So G company paid an interim dividend of 6 cents per ordinary share of on 31st October and declared a final dividend of 8 cents on December. So there are two dividends which are being paid. One is a half yearly dividend and one is the final dividend. And then the ordinary shares are trading at a cumulative dividend price of 1.83. We over here need to work out the dividend yield. So basically dividend yield is nothing but all of the dividend which you have received divided by the share price, and share price should be always X dividend. So let's first see how much is the total of our dividends. So the dividend for the entire year, firstly we got 6 cents and then we got 8 cents. So if you total this up, it becomes 14 cents of dividend. 14 cents of dividend in the entire year. Now you need to divide this by your X dividend share price. So cumulative dividend share price is given to you as 1.83. Now this has built into it the 8 cents of dividend which is about to be paid. So to make this X dividend share price will be equal to 1.83 minus 0.08, which gives you 1.75. Now to arrive at your answer, your dividend yield will be nothing but 0.14 divided by 1.75, which gives you 8%. So 8%, option number D is our answer over here. Moving to the second last question for this chapter, you have a company's share price 1 year ago was 1.47. Quarterly dividend of zero point 0.2 per share is paid, and the current share price is this much. So the current share price is also given to you. Now, what is the total shareholder return? Now, total shareholder return is worked out by adding all of the dividend plus the capital appreciation, that means the difference between the opening and the closing divided by the opening share price multiplied by 100. So this is what the formula is. Now let's put this into place. Now we have to calculate for the entire year and we have a quarterly dividend of 0.2. So 0.02. So this has to be multiplied by 4 to give you your annual dividend. So this gives you 0.08 as your annual dividend. Now talk about capital appreciation. So that is nothing but the difference between the opening price and the closing price. So currently it's 1.62 and at the beginning of the year it was 1.47. So if you work out the difference, 1.62 minus 1.47, you get 0.15. So now your numerator becomes 0.8 plus 0.15. 0.15 plus 0.08, this gives you 0.23, and this needs to be divided by your initial value, and your initial value was 1.47 divided by 1.47 gives me and then multiply this by 100. So 15.64% is what I'm getting. So this will make your answer as option A over here. Then we move ahead to the last question. So this does not involve any numerical. So we can go back to the full screen. Which ratio provides investors with a measure of the risk of not receiving dividends? So basically over here we are seeing what is the risk of not receiving dividends? What is the risk that the company will not have enough cash, will not have enough profits or cash to give them the dividend, to give the shareholders the dividend? So, if you talk about dividend payout ratio, this does not talk about receiving, it just gives you how much is, compared to the earnings, how much the company is paying the dividend. And dividend yield also has nothing to do with the risk of receiving or not receiving. Dividend ratio is no ratio at all. So we are left with option C. Now, why this is the answer is because dividend coverage ratio basically talks about how many times a business will be able to pay out the dividend with the level of profits, with the level of cash that they have. So basically, even if the dividend has been declared, maybe the business is not having enough profit, or maybe the business is not having enough cash. So that is what the coverage ratio will tell you. So, for example, if the coverage ratio is 100 times, let's suppose, so that means that the company is in a position to pay the dividend with the amount of funds that it has 100 times. Whatever is the dividend, they can pay the shareholders 100 times. So that means it's not risky. They will receive their dividend because the company is in a good position. Similarly, if it is lesser than 1, then the company is not in the position to pay the dividend. In that case, the risk of not receiving dividend is high, almost as true as, virtually certain. So this over here, option C will be your answer. With this, we have come to an end to this quiz. I hope that this helped. And if you want, you can let me know in the comments down below if you want me to solve any quizzes from more chapters. Thank you for watching. I'll see you in the next one.